Hi, I'm Gildas Quinquis, the Chief Investment Officer at Windrose Advisors. And today we're going to do something a little different. Welcome to this special investment webinar sponsored by Windrose Advisors. Our topic today is opportunistic credit investing. And our guest is Darren Richman, one of the two founders of Kenny Lewis Investment Management. But before we get started, I need to read a brief disclosure. The opinions expressed in these discussions are those of the Windrose Advisors LLC team. The opinions referenced are as of the date of recording and are subject to change due to changes in the market or economic conditions and may not necessarily come to pass. Past performance does not guarantee future results. Forward-looking statements cannot be guaranteed. Windrose Advisors LLC is an investment advisor registered with the U.S. Securities and Exchange Commission. Registration does not imply a certain level of skill or training. Windrose reserves the right to modify its current investment strategies and techniques based on changing market dynamics or client needs. The information contained in this presentation is provided for informational and discussion purposes only. This presentation is not intended to be, nor should it be construed or used as an offer to sell or a solicitation of any offer to buy an interest in any fund or any other entity, which offer may only be made at the time a qualified offeree receives a confidential private offering memorandum and related subscription documents. Darren, thank you for joining us today. We have a lot of questions to ask you. But before I jump in with those questions, I want to briefly share your background with our audience. Kenny Lewis is an institutional alternative investment firm focused on private credit strategies. The firm currently oversees over $25 billion in assets under management on behalf of more than 600 limited partners across its various funds. Darren Richman co-founded Kenny Lewis with David Cheney in 2017. Mr. Richman is a co-portfolio manager and a co-managing partner of Kenny Lewis, and he co-chairs the firm's investment committee and executive committee. He is the chief executive officer and president of Melrose Properties, a publicly traded REIT focused on land banking that is externally managed by a Kenny Lewis affiliate. Mr. Richman was formerly a senior managing director with Blackstone from 2006 to 2016. He focused on special situations and distressed investments, and he sat on the investment committee for many of GSO's special situation-oriented funds. Before joining GSO Capital Partners, Mr. Richman worked at DiMaio Ahmad Capital, where he was a founding member and the co-head of its investment research team from 2003 to 2006. Prior to joining DiMaio Ahmad, Mr. Richman was a vice president and senior special situations analyst at Goldman Sachs from 1999 to 2003. Mr. Richman began his career with Deloitte & Touche, ultimately serving as a manager in the firm's merger and acquisition services group from 1994 to 1999. Mr. Richman is on the board of Outward Bound USA and the executive board of New York University's Stern School of Business. He's a member of the Economic Club of New York and formerly served on its strategic planning committee. Mr. Richman received a BS and BA degrees in accounting from the University of Hartford in 1993 and an MBA from NYU's Stern School of Business in 2000. He was formerly a certified public accountant and a member of the American Institute of Certified Public Accountants. Thank you again for speaking with us today. My first question for you is, you took an entrepreneurial leap to found Kenny Lewis with David Cheney. Can you please tell us about what drove you to start a new firm and what were the advantages of starting fresh?
Yeah, I think what drove us was just a great entrepreneurial spirit. I'd been associated with a number of startups through my career. Credit Suisse spun out to form DiMaio Ahmad. So I was there in the early days. I was there in the very early days of GSO, and I started in 2006 and left 2016. And having watched what others built, I thought we could replicate a lot of that. And as successful as GSO was and continues to be inside of Blackstone, there were things that we thought we could do, particularly on the non-sponsor credit side. And at that point, GSO, Blackstone was really moving into the sponsor markets. And we thought we could be excellent in this space. And that's what drove us, maybe a little bit of naivete of believing we could do it. And then, with me and David and the rest of the team, I'm very proud of what we've been able to accomplish in a short space of time.
You mentioned non-sponsored lending, which is an area of focus for your firm. Can you please explain that term and why that's a preferred area of investment for you?
Yeah, the difference between sponsor and non-sponsor is really a function of go-to-market strategy, but equally, it's a function of sourcing. In the sponsored markets, it's usually in the context of a buyout, a private equity firm buying out a target. And these are usually associated with auctions. They're very rigorous, very choreographed. And once a sponsor wins the auction, they turn their attention to how they're going to finance it. And these are very efficiently run processes, usually intermediated by a bank. Non-sponsor is the exact opposite of that. There's almost no efficiency in that process. And because there's no efficiency, and I'll talk a little bit about our go-to-market strategy, there is room for more excess return, better structural protections, more rate in general, by being with less efficiency in that process. And so for us, non-sponsors really thinking about stepping back, thinking about where there's disruption in the economy. How does that disruption manifest itself in the need for private capital? Which companies are going through a period of disruption? What's causing it? And then which companies are being impacted? And we've been doing this style of investing going back to, it was originated by us at GSL Blackstone. And it's really been refined since we're at Kennedy Lewis, where we've chosen very specific parts of the economy that at worst are neutral to the economic forces as a backdrop, but hopefully the economic forces are positively impacting these sectors. And that's what brought us to life sciences. That's what brought us to power and energy transition, to opportunistic cyclicals, to homebuilder finance, and the other sectors that we source from. And then we have an entire team of individuals who, partners and other employees, whose sole focus is to operate within each of these verticals. We've become very well known as investing in these verticals. And we then go and source our own opportunity set. And again, that drives extra value for our investors. That inefficiency of go-to-market is really responsible for some of the alpha that we're able to generate in the process.
Well, that's great. You hinted at your investment style, which we often describe as opportunistic credit investing. Can you go a little deeper and tell us what that means? What are some of the opportunities that you're able to pursue with that style?
Yeah, some people associate opportunistic credit is another moniker for distress. We're distressed folks by background. So each of us in the senior leadership at Kennedy Lewis have distressed backgrounds. That is not our go-to-market strategy. Distress is really episodic. There's a moment in time, after COVID, going back to the financial crisis, going back to the recession of 2001, there are periods where there's time to do distress. But for the vast majority of the time, it's not. So opportunistic for us really is thinking about having a portfolio, having 6 or 8 different verticals. We're not sure if life sciences is going to be very productive in one vintage of a fund, if land banking is going to be productive, if opportunistic cyclicals. And so being opportunistic really means we're not exactly sure what the contour of the portfolio is going to look like, what the character of the loans are going to be. But we are sure that we're going to fill it with very responsible, almost in all cases, first lien, top of the capital structure. And so that's what it means to be opportunistic. It's to allow ourselves the freedom of movement to go find the best risk-adjusted returns in the marketplace, to go find those companies that have been displaced by traditional economic forces, have been displaced by their traditional banking sources. And we're never sure exactly where that's going to come from or what form it's going to take. And that's exactly what we've been doing for the last 20 years.
So we talked a lot about corporate lending opportunities across various sectors. You're also active in asset-backed lending. Can you please explain for our audience what that implies?
Yeah, asset-backed is really a evolution of corporate financing. In corporate, you're generally making a loan to a company and they're paying it back with EBITDA and free cash flow. In the asset-backed markets, it's the actual returns that you're getting off of a structure or a security that is leading to the return. It's not the corporate that is paying you. It is either the structure that's paying you or the security. And if you think about a corporate balance sheet, there's inventory that could be financed separately. There are receivables on that balance sheet that can be financed separately. So it's really kind of thinking within a corporate balance sheet or other financing structures where you're packaging future cash flows into a structure, and that is acting as the collateral coverage for that structure. Like what we do in land banking is a big example of asset-based finance, where we're buying the land off of home builder, either their balance sheets or land that the home builder was going to buy itself, and we're financing that land. That would have been inventory on their balance sheet that we're financing separately.
So your strategy is private credit, meaning semi-liquidity. Do you believe that investors can earn a risk premium for investing in illiquid securities?
Yeah, and they should. We believe that, yes, and they should earn a premium. And that's really going back to the difference between the sponsor markets and the non-sponsor markets. In the sponsor markets, the risk premium is pretty skinny relative to the risks that you're taking. In the non-sponsor market and in the illiquid private credit markets, that's exactly it. The structure, we're doing things in the market where it takes a contrarian mindset. We're doing things where there's some complexity, where a company knows they have a problem, but hasn't really defined what the solution needs to be. And by coming to the aid of that company and working with them to create a customized financing structure, we are able to get excess return for doing that, for using our creativity and our ingenuity to drive an outcome, usually comes with added return.
Darren, for newer investors to the asset class, private credit can feel opaque compared to public markets. Can you explain what level of transparency and reporting investors can expect from a manager like Kennedy Lewis?
Yeah, look, we're a private credit manager with just about $29 billion of assets under management. We consider ourselves to be an institutional quality manager. From the very opening days of Kennedy Lewis, we've established a relationship. And we are incredibly transparent. We are incredibly thankful to the LPs who came on our journey with us. But to answer your question, we provide reporting on whatever schedule our clients come to need. Mm-hmm. We have a host of clients from multifamily offices, individuals, sovereign wealth funds, state pension plans. And very often they're going to have some customized need for reporting. And we find ourselves organizing our efforts to meet our clients' needs. So whether it's monthly reporting, quarterly reporting, annual reporting, all our funds are audited by Deloitte & Touche. So whatever a client would need is what we will give them.
Right. And thank you. I know your team has been very available to describe the portfolio. You and I met in 2018. It's hard to believe all that time has passed when you were raising your first fund with David. Since then, private credit has really emerged as a large and established asset class. Can you speak a little bit about what changed in the market that drove such interest in the recent years?
Yeah, there's been a few pivots in the market. The first is just the size of in general, the private credit markets initially were influenced by the sponsor-backed financings. And you had companies that were specifically raising funds, Blackstone, Ares, Blue Owl, and others, to meet the needs of sponsor-backed direct lending. And as the LBO volume increased, so did the need for capital, and so did those entities. And so that was definitely one element that led to it. The other that happened is, given COVID, given interest rates going up, given Silicon Valley Bank, you've had banks now pulling back and really thinking about what type of risks they want to take, shrinking their own balance sheets, and that credit has to go somewhere. And so I'd say the next wave is folks like ourselves gaining more share because there's just more opportunity to do it. And then the other thing is, since the private credit markets can provide more customized solutions, more and more companies are dealing with challenges where there's not a one size fits all, where I kind of equate it to an individual who brings a shoebox full of receipts to their tax attorney at year end, not necessarily knowing what to do with that. And somebody's got to organize and make sense of it. Well, there are a lot of companies out there that are in a very similar shape, not necessarily with a box of receipts, but where they know they have a fundamental challenge with their capital structure, and they need a more customized solution to fit the needs of that company. And so very importantly, we'll sit down with the CEO, we'll sit down with the CFO, we might sit down with the board of directors. And if there are sponsors, we might sit down with them to try to understand what it is they're trying to accomplish, to look at a solution from their lens. What would we do if we were them to create a financing solution? And it's really that customized approach that, again, gives us added protections from a covenant and a structure perspective. It gives us excess return, but we are also providing a service of value to a borrower because they're getting something that fits their specific needs. It's been customized to meet their needs.
So today, yields are high, defaults are low, and some investors have called for a golden age of credit investing. Do you share that view? Maybe what are some of the risks that investors should keep in mind when evaluating private credit?
Whenever somebody throws the term, this time is different or golden age, I think people can get skeptical and deserve to get skeptical. So I don't believe this is a golden age. I do think that the private credit markets will continue to grow, will continue to take share. We'll see what happens in the sponsor markets because that's really going to be a function of LBO volumes. But in the non-sponsor market, we absolutely think that there's going to continue to be growth in both non-sponsor and asset-based finance. And it's really, again, a function of the banks pulling back. And yeah, there are risks where the risks are, these are in general leveraged borrowers. Too much leverage is not your friend, okay? That creates its own imbalances in capital structures. So understanding how levered a company is. Number one, if anybody's going to do it, you want to deal with experts, folks that have been through cycles, folks that have restructuring capabilities if there is a company that stumbles. We have an added benefit of having distressed backgrounds. So when we do a private credit facility, we're thinking about it from structural protections. We're thinking about it from the value of the collateral and the extent to which we could liquidate that if we get into trouble. So let's not forget that these are levered businesses, and too much leverage is going to create imbalances. And then you want to make sure that you're dealing with investors like ourselves that have the expertise and the restructuring capabilities if something does go wrong.
You're talking about opportunities in non-sponsored lending. Oftentimes that's perceived as risky, but can you talk about all the protections and covenants you're able to structure into it and maybe go a little deeper into recoveries in times of trouble?
Yeah, and this is also an area where there's a difference between sponsor and non-sponsor. In sponsor, usually the credit protections are being conveyed to you by the sponsor. I'm not saying there aren't any, but it's more porous, those documents. In the non-sponsor and what we do, it really is a customized approach relative to the situation. We're working with a company. That company is probably going through some transition. So we don't want to make the covenants too tight because we're not trying to default somebody, right? That isn't the idea. We're not trying to do loan to own. So we'll work with the company to try to understand what it is they're trying to accomplish, what then are the tolerances that they would be upset if they couldn't hit, and then build covenants around the company's plan. Now, having said that, your other part of your question is recoveries. When something does go wrong, historically, we have done better as a firm, because when something doesn't go right and there is a restructuring, we have already thought about that as part of our underwrite. And we've thought about what would we do if we were the CEO or on the board of directors, and how could we reorient the company or reorient the collateral to make sure that we get a recovery plus our contractual return and maybe a return on top of that. Right. And so that really does come from experience. Yeah. And we've made mistakes. So part of being in a position that we're in now is like everybody, you make mistakes across the way, and you try not to make those mistakes again. And that our clients get the benefit of that. Yes. We're not perfect.
Right. Protecting on the downside.
That's right.
Yeah. In recent years, we've seen significant growth in retail interest in private credit, driven by the search for yield and new fund structures offering greater access. As this once institutional space becomes more accessible to individual investors, there's growing curiosity, but also concern about how to approach it wisely. What would you say to retail investors?
There is definitely a democratization of alternatives in the retail channels. And I think by and large, that's a very good thing. I think individual investors getting access to the same products that institutional investors have historically had access to makes a lot of sense. In general, these retail platforms are very under invested in alternatives, maybe just a couple of percentage points. And like any responsible portfolio, there's a good mix of public, private, debt, and equity. And alternatives should definitely be a part of, I think, everybody's portfolio. And so I think by and large, the retail distribution and penetration makes a lot of sense. And I think it'll continue.
Right. Darren, as retail investors increasingly look to access private markets, specifically credit strategies, how should a first-time investor think about the trade-off between yield and risk? What frameworks or questions can help guide their evaluations?
Before anybody considers the return, they should consider the risks that they're taking. Are they comfortable with those risks, regardless of what they're getting paid? The old adage is there's a price for everything, right? It's not product, it's price. Totally understand, which is a function of return. But investors should really first consider, what are the risks that they're taking? Do they really appreciate those risks? And then given that level of risk that they're going to accept, do the returns compensate them for those risks? Very often we look at deals that screen as great investments because the returns meet our needs. But as we really dig into the fundamentals of the business, we realize that the risks are just too great. That while the return on paper looks good, the real expected return is much lower relative to those risks. And sometimes it's just not worth making an investment regardless of what the return is. Maybe it's not the right time, maybe it's not the right company, maybe it's not the right security in the capital structure. And so we're always thinking about what risks we're taking before we're really considering what we're getting paid for those. And that's part of having an opportunistic credit strategy, an opportunistic fund, is we get to curate the portfolio as we want it, given the economic backdrop, given what is going on in the markets.
I think it speaks to having experience in the markets, right? And having lived through multiple economic cycles and knowing what to expect in multiple scenarios.
We were asked a question just the other day by an investor, and they said, when interest rates went up by 500 basis points, or when tariffs were announced, Liberation Day, were we quick to go into the markets to buy risk. And the response I gave is a little bit broader. And I said, number one, the market's never dislocated enough for us to move into the public markets. Usually we'll move into the public markets when credit spreads are like closer to 600 basis points or 700 basis points. But really what we're looking for, let's go back to COVID. In every crisis, there is really there's kind of three levels to the crisis as far as the market is concerned. The first is liquidity. There's a flight of redemptions. Mutual funds are net sellers. Folks are looking to go to their cash machines to take out money. And so liquidity gets zapped from the market. But being a liquidity provider early on in those down cycles is very advantageous, okay? The second part of that, when usually the government has done a good job of coming in and stabilizing the market from a liquidity perspective. The second evolution is solvency. And that is which companies, given the economic shock or economic condition, are going to make it and which ones are not going to make it. And you get paid very handsomely by being able to pick those businesses that will remain going concerns and solvent. And then the third element is recovery. And that's usually when you don't mind going junior in a capital structure, maybe unsecured or equity risk, to capture the other side of that cycle.
Well, it's very topical. Uncertainty seems to be the key word in the markets this year. How do you think tariffs could impact credit markets in the coming year, and what actions are you taking in your portfolio to adjust?
The tariffs is kind of a funny situation, because if all you were looking at is the public markets, you would think all clear. President announced them, a lot of volatility, markets are all back, so no issue. And that really, that doesn't tell the whole story of, there are a lot of companies today that are dealing with trauma to try to understand. They have global supply chains that are real choreographed against their production cycle. And they're trying to figure out, how do they get these input products? And if they can get the input products, what do they cost? And then what are they supposed to charge their customers for these products? And we're seeing a lot of this out in the marketplace. Companies that came into 2025 not thinking they were going to be borrowers, but maybe now on the back of tariffs needing to buy inventory ahead of when they'd need, and or buying safety stock of inventory. And so their cash positions are not what they thought when they were putting their budgets together at the beginning of the year. It's a great tailwind for us. And one of the things we do is we talked about it, we invest around disruption. Well, sometimes disruption comes in the form of regulatory disruption. And that is exactly what we're seeing in the form of tariffs. And that has been very good for our business, not necessarily good for the economy. But the tariffs are unfortunately creating more inflationary pressures in the economy. And we had a view that we would see higher inflation more because of demographic changes, more because of a reorientation of supply chains. This is just another another factor of those trends that were already in place. We believe that we'd be operating under a higher interest rate environment, which is exactly what we're dealing with. So it hasn't really been a change to our business. And for anybody who followed the president in his last administration, you got to see that tariffs were an important part of his platform, of his foreign policy. And if you were following his words closely during the run-up to the presidential election and even the inauguration, he was speaking very forcefully about tariffs. So I think many were surprised by Liberation Day, but if you've been kind of following along, he was communicating to the world that this is something he was very seriously considering. And so we heeded his advice, as you're probably supposed to do. And so our portfolio is pretty well insulated from that.
Oh, that's great. Darren, what's an example of a good risk-adjusted opportunity you see in credit markets today?
Well, one of the opportunities that I'm most proud of and have a background in is what we do in land banking.
Mm-hmm.
I was a home builder analyst early in my career at Goldman Sachs. I led a number of rescue deals during the financial crisis in housing. I've been around this sector my whole career. I have a real passion for residential real estate. And effectively what we're doing is we are helping home builders transition their balance sheets from land-heavy companies to asset-light companies. Mm-hmm. And what I mean by that is we're buying land on their behalf. They have almost like a triple net lease on that land where we're buying it, but they're developing it, bringing it to its intended use so that it's available on a just-in-time basis for their production schedule. No different than plumbing supplies or other building materials that they might acquire. And what's so unique about this is we're buying this on their behalf at roughly 60% loan to value. We own it. They're paying us somewhere between 11 and 13% while we warehouse it for them. Mm-hmm. It's all choreographed in a production schedule. So we know how many home sites they're going to take down in any given period per month, per community that is on a production schedule. And we've never had, for all of these deals that we've done, and we've done a couple 100,000, we own a couple 100,000 home sites. We've never had one home builder walk away from this risk. So I think this is the best risk-adjusted return in the market. It's a big addressable market. There's somewhere between 150 billion and 200 billion of land that is going to transition over time off the builder balance sheets. This is no different. I was an auto analyst also in my career, and this is no different than when the autos divested themselves of steel making capacity mm-hmm. or other assembly capacity, and really focus their business on being a consumer brand and consumer products that the customer wanted. Well, this is exactly what's happening in home builders today, where they're splitting themselves into an OpCo-PropCo structure, mm-hmm. and they're allowing themselves to just focus very specifically on being consumer brand companies, creating consumer products that the market wants. And hopefully in that process, they're softening some of the cyclicality of that business, just like the autos did. They're increasing asset returns, increasing margins over time, and hopefully they get re-rated, just like the autos have been able to do.
Darren, every year at your annual meeting, you invite a speaker to discuss a book they wrote on a topic that is relevant for investors. What book is on your reading list today?
There are two books, and they deal with a similar topic of global warming. Mm-hmm. One book is called The Great Displacement, and that is about migration patterns and trends in the United States given global warming and housing migration as a result as well. And the other book that I recently read is called Warming Up, and it's about global warming and its impact on sports. And both of them are really interesting.
Wow. I look forward to hearing more at the next meeting. Darren, thank you again for speaking with us today and all your thoughts. Congratulations on all your success at Kennedy Lewis.
Thank you very much for having me. Really appreciate it. And for the relationship. We're grateful.
You're very welcome.